Have you noticed the recent changes in China's investment strategy? A seismic shift is happening in the world of finance, and it's all centered around the globe's second largest economy, China. They're making waves with a new investment strategy that's sending ripples through the global market. China, a country known for its strategic moves, is moving away from US Treasuries and turning its attention to gold. This isn't just a minor adjustment, but a significant pivot that's making economists, investors, and governments sit up and take notice. But why gold, you may wonder? Well, with the outlook of the US dollar weakening, gold offers a stable and secure alternative. Its value is universally recognized, and it's a resource that has stood the test of time. The implications of this shift are far-reaching and could potentially reshape the global economy as we know it. With the US dollar's hegemony in question, the balance of power might be tilting. As we delve deeper, let us explore the reasons behind this monumental shift. China, once a significant holder of US Treasuries, has started to reduce its holdings. This shift is a significant movement in global finance as the Asian giant begins to reshape its investment strategy. Now let's take a closer look at the extent of this reduction. Over the past few years, China has been subtly yet consistently decreasing its US Treasury holdings. The country, which was once the largest foreign holder of US government debt, has now slipped to the second position, surpassed by Japan. This reduction is not a sporadic move. Instead, it's a calculated decision that's part of a broader strategy to diversify its foreign reserves portfolio. The economic implications of this decision are multifaceted and far-reaching. For China, reducing its US Treasury holdings is a move towards minimizing its exposure to US debt and the dollar. This strategy offers a buffer against the potential risks associated with the US fiscal policy and the dollar's global dominance. On the other side of the coin, this reduction can have significant implications for the US generally. Foreign purchases of US Treasuries help keep American interest rates low. Therefore, if China continues to reduce its holdings, it could lead to higher interest rates in the US, affecting everything from government borrowing costs to mortgage rates. However, it's important to note that this doesn't necessarily spell disaster for the US economy. Other countries could step in to purchase the US Treasuries that China's offloading. Additionally, the US Federal Reserve could also increase its purchases of treasuries to keep interest rates at bay. But beyond the immediate economic implications, this move also signals a broader geopolitical shift. It's a demonstration of China's growing confidence in its economic prowess and a clear sign of its intent to reduce its dependence on the US dollar. This shift in investment strategy by China has raised eyebrows around the globe. As we move forward, it will be interesting to watch how this plays out on the global stage and what it means for the future of international finance and the balance of economic power. As China reduces its US Treasuries, it has been significantly increasing its stockpile of gold. This isn't a spur-of-the-moment decision, but a strategic move that's been in the works for quite some time. China has been progressively diversifying its foreign reserves, and the yellow metal has been on its radar. Why gold, you might ask? Well, gold has been a trusted store of value for centuries. It's a safe haven during turbulent times, and let's be honest, the global economy has been on a roller coaster ride for a while now. Moreover, it's a tangible asset that doesn't depend on any country's economic health or political stability. Now let's delve a bit deeper into China's gold buying spree. The country has been consistently adding to its gold reserves, and in no small quantities. This implies a concerted effort to strengthen its financial muscle and reduce reliance on the US dollar. But what's the ripple effect on the global gold market? As one of the largest consumers and producers of gold, China's actions can sway the scales. Its massive gold accumulation could push prices higher, making it an even more attractive investment. And with the global economy still wobbly, investors could also turn to gold as a safe haven, further fueling demand. But there's more to this golden story. China's gold accumulation isn't just about economic resilience, it's also a strategic move to bolster its currency, the yuan. A stronger gold reserve could potentially elevate the yuan's status on the global stage, providing China more control over its economic destiny. What we're seeing is a fascinating chess game of economic strategies. China is playing for long-term gain, and gold is a critical piece on its board. With its growing gold reserves, China is undoubtedly repositioning its economic standing on the global stage. And that's a move worth watching. Parallel to these shifts, the outlook of the US dollar appears to be weakening. This is not merely an isolated phenomenon, but a part of a larger, global economic narrative. The strength of the US dollar has been a cornerstone of international trade for decades, but recent trends suggest a change on the horizon. To understand this, let's delve into the factors contributing to this weakening outlook. A key factor is inflation. The US has been grappling with rising inflation rates, which have surpassed the Federal Reserve's target. This has led to a decrease in the purchasing power of the dollar, thereby weakening its value. Simultaneously, another factor at play is the Federal Reserve's monetary policy. The central bank's decisions to maintain low interest rates and continue with quantitative easing have flooded the economy with dollars. This increase in supply, without a corresponding increase in demand, naturally leads to a devaluation of the currency. But it's not just internal factors that are causing a shift in the dollar's outlook. External influences, such as China's decision to diversify its reserves by reducing its reliance on US Treasuries and increasing its gold holdings, are also playing a significant role. This shift by one of the world's largest economies could encourage other countries to follow suit, leading to a decrease in the global demand for the dollar. So, what does this mean for the global economy? Well, a weaker US dollar could have far-reaching implications. For one, it could make US exports more competitive, potentially boosting the American economy. On the flip side, it could increase the cost of imports and contribute to further inflation. Additionally, for countries that hold large amounts of US debt, a weaker dollar could lead to significant losses. In conclusion, the weakening US dollar outlook is a concern not only for the US, but for the global economy as a whole. As we continue to navigate these uncertain economic waters, it's important to keep a close eye on these shifts and their potential ripple effects around the world. The implications of China's new investment strategy are far-reaching. China, as one of the largest economies in the world, has a significant influence on global financial dynamics. Its shift from US Treasuries to gold could potentially reshape the landscape of international finance. For one, the reduction in China's purchase of US Treasuries could lead to a rise in US interest rates. This is because the demand for US Treasuries and the interest rates have an inverse relationship. When demand decreases, interest rates increase. Higher interest rates could lead to a slowdown in the US economy, affecting businesses and consumers alike. Secondly, China's accumulation of gold could potentially drive up the price of the precious metal. This could be beneficial for gold investors and countries with significant gold reserves. However, it could also lead to increased volatility in the gold market, making it a riskier investment. Now let's discuss some possible interpretations of this strategy. One interpretation could be that China is preparing for economic uncertainty. Gold is often seen as a safe haven during times of economic turmoil. By accumulating gold, China could be aiming to protect its economy from potential shocks. Another interpretation could be that China is attempting to reduce its reliance on the US dollar. By shifting its reserves from US Treasuries to gold, China could be aiming to diversify its holdings and reduce its exposure to US monetary policy. However, it's also important to note that these are just possible interpretations. The Chinese government has not explicitly stated its reasons for this shift in strategy. It's also possible that there are other factors at play that we are not aware of. In conclusion, while the implications of China's new investment strategy could be significant, they are also uncertain. There are many factors that could influence the outcome, including the actions of other countries, global economic conditions, and the future policies of the Chinese government. Only time will reveal the true impact of China's new investment strategy. In conclusion, China's new investment strategy is a game changer. The significant shift away from US Treasuries towards amassing gold is a clear indication of the economic repositioning China is undertaking. Amidst a weakening US dollar outlook, these changes are not just pivotal for China, but also have far-reaching implications for the global economy, investors, and other nations. It's crucial to remember the key points we've discussed today. Firstly, China's shift away from US Treasuries is a major move that could potentially influence the global market. Secondly, China's accumulation of gold underscores its confidence in the precious metal as a store of value. Lastly, the weakening outlook for the US dollar is a significant factor driving these changes. These economic shifts underscore the importance of staying informed and adaptable. The world of finance is ever-changing, and these changes could herald new trends or indicate shifts in global economic power. As we continue to track these developments, remember, in the world of finance, change is the only constant.